Hello, welcome back to Hoisting Income. We are in the month of June and close to ending the first half of the 2026, and the markets are at all-time highs, and we don't know how far it can go higher, and what are the sectors that are going to outperform, what are the areas that are going to give you strong returns. That's always a kind of you know um, confusing part. Like you don't have the crystal ball, like, unless you are Nostradamus, you can predict where the markets are going. So here the idea is some people like to invest in the index, and there are index ETFs such as SPYI and XDTE, which provide you the index exposure plus returns based on the option strategy on the index. So the question on this video is: did I hit the jackpot with XDTE, Roundhill Fund, or miss out big time on SPYI, which is the NEOS High Income S&P 500 Covered Call Fund? Uh, Both have similarities. They both track the S&P 500. And let's look at the features of each of them, compare them head on, and side by side, and then see what are the differences. And at the end, I'll also discuss about what I have done or where I am. Like, did I really make it big, or did I miss something? I'll discuss that at the end of the video. So please stay tuned till the end. Okay, with that said, this video is only for entertainment or education purpose only, not a financial advice. So if you need more specific advice, contact your financial advisor or accountant. Okay, with that said, we have two different funds, SPYI and XDTE. If you're not familiar, SPYI is the NEOS S&P 500, which I have on the left side of the table. So I'm going to follow this format so it's easier for you to visualize and see the difference. On the right, we have XDTE, which is the Roundhill S&P 500 zero DTE covered call strategy. I'm going to give you a brief background, then we are going to look at the expense ratios, distribution yield, price return, total return, the portfolio, the investing strategy, and so on. There's a lot of things to unpack. Let's go one by one. The first is the fund background. Like this is one of the most important areas that people miss out when picking a fund. Probably you saw some video on YouTube or someone on Instagram recommending a fund, you just jumped into it. Uh, the important thing is you have to look at the track record, like how long the fund has been in place, how it has performed, how the fund managers have been managing it, and are they sticking to their strategy or they have changed the strategy, what is happening, and what are the returns. The first part is the background. The SPYI is about, you know, close to 4 years old now. August 2022 was the inception. And XDT was like launched in March 2024, about 2 years now. So yeah, SPYI has a longer history. And also from the assets under management, if you look at that, SPYI is into 10 billion roughly, and XDT is 334 million. So obviously SPYI has a higher assets and it has a longer history as well. So that gives it a kind of an edge here. Uh, but it doesn't mean that XDT is not good. Like each fund has its own, focus. XPYI is known for index and asset-based strategies. So they provide you exposure to a specific index or specific asset, and so you get that asset exposure. So you asset goes up or down, you get that exposure. Plus, you get the income out of the asset using the option strategy, like selling covered calls. Now move on to XDTE. They were a fund which was focused on thematic ETFs in the past. Now they are focusing on some of the weekly, income ETFs and synthetic funds. Like, uh, if you're not familiar with synthetic funds, you can also watch one of my previous videos on XDTE. But for now, synthetic fund means the fund is using call option instead of buying the index. Instead of buying the index ETF, the fund is using the call option. Or instead of buying the asset or the stock, they're using the call option as a to get that long exposure or to get exposure from that stock. So basically, they are not holding the real ETF or the real stock. So that's how XTT is different. because the underlying asset is a call option. So those are the differences between the two funds. And as we go ahead, you will understand these differences. Uh, so if you have any comments, any questions on this, you can feel free to drop them below. I'll be happy to explain that. And the main thing that we are looking for is cost. Like if you are looking for a cheaper fund, you might be, more focused on the cost factor. But this is just one of the factors among many others. So for me, I would not just go by merely the cost, but I would look at other factors too. Yeah, everybody has that, you know, fancy for the cheaper funds, but you need to look at it in the overall context. So SPYI is charging about 0.68% expense, and XDTE is 0.97. Subtle difference. We will see it when we look at the investing strategy. XDTE is actually generating income on a daily basis. SPYI is mostly like monthly call options. So SPYI does a monthly strategy, like they write calls every month, or it's based on a monthly cycle. Whereas XDT is actually generating you income every single day. Every trading day, they are writing options. So, which means that they do a lot more work, lot more transactions. So, that explains the difference in the cost. So, I don't see any dramatic, difference because when we make an apple to apple comparison, like, you know, fat comparison, then XDT and SPYI are more or less on the same page. Higher cost is due to the higher volume of transactions, more involvement of the fund manager in zero DTE calls. So that said, let's go to the next area. Oops, I'm got to the previous page. Let me go back. Okay, we will now look at the returns. So I'm not going to go into each in every aspect, but I will going to give you a quick summary of everything which I've done, all the math in one place. So in terms of purely the price return, like if you look at the ETF price in the last 1 year, so I'm looking at just the last 1 year to see how the fund have performed. And then I'll show you the other, long-term performance as well. In the 1 year performance, SPYI made about 9.5% in price returns. The first row you can see. But you see XTDE, they lost 7.5%. So that's one aspect of it. But what has happened is in terms of the distribution yield, SPYI delivered about 12%, XDTE delivered about 32.9%. Okay, this is just the last 1 year, okay, because we had a good bull market and stock prices went up, and you had these covered call ETFs also going up in price. Some of them went up, some of them did not catch up. So yield wise, XDT is beating SPY by a huge margin, whereas in terms of the price, SPY is still better. In terms of total return, like HDD is actually beating the SPY, 25% and 21.5%. So it's beating it by about close to 4 percentage points, which is dramatically higher. And the other point you need to note that is, the distributions that come out of the fund are monthly in the case of SPY, and they are weekly in the case of XTD. So there could be two reasons. Like one is the weekly or higher frequency of distributions and high income, which makes XTTE more attractive in the yield point of view, because they generate option income every single trading day, whereas SPY is generating monthly income. So in terms of the yield or in terms of the income generated by fund manager from the options, XTT actually makes more money, whereas SPY makes slightly less. Okay, so this can be viewed in a different way. Like if I just look at the total return performance last 1 year, XTT wins. SPY is slightly behind, not so bad. They have performed really well. Uh, which fund would you pick? I don't think there's much of a difference. There are some issues with XTTE, like you might see the price going down sometimes, and your yield may be a little higher. Sometimes the yield can be lower as well because the distributions are highly variable. Imagine if you're making lesser yield, let's say 20%, and then you lost 7.5%, then this picture would look completely different. Or if the price return went down by 10% and yield was just 15%, then you are depleting in value. So that would be a different scenario. But as of now, things are going pretty well for XDTE as well. But if you're someone who wants to see your fund value remain stable or move up higher, you would prefer SPYI because you see the stability in the price return. You not only want the dividends, but you don't want depletion in your fund value. You don't want the principal to reduce. So that's why you would prefer SPYI. Uh, some people would prefer XTTE. Now, I invested in XDTE. I knew this flaw in the fund. Like, I knew this is one of the issues in the fund, but this is not an issue or a flaw. This is the feature of the fund, and you have to be aware of the feature. And that is one of the reasons why I said in my previous videos that don't use these funds, especially these income funds, weekly income funds, for core investment part of your portfolio. This cannot be the core. Probably you can use it as a small portion of your portfolio to generate that regular flow of income. And that income can be used to invest in other ETFs, other areas, or a small part can be used to reinvest back into the same fund if you see the fund is available at attractive price. So that's one part of the question that I answered now. That it's not a big time loss or it's not a big issue, but I'm managing that pretty well. But there are some people who have done well with SPYI, SPYI, and that's perfectly fine too. Okay, let's move on to the next part. Total return wise, I think XGTE wins, but SPYI is not that behind. Like they're still doing good. Now, what's making that return? That's the secret sauce or the investing strategy that we need to look at. A lot of funds, including these ones, do not provide you all the information that you're looking for in terms of the strategies because sometimes things change dynamically every day or every month, week, whatever. Like so, you will get some information from the websites. I pulled out some information, and this can change. Like just to give you a disclaimer that what we are seeing now is not like set in stone. Some of the things can change a little bit here and there, but the portfolio is based on the underlying stocks of the S&P 500 index. In the case of SPY, underlying stock means, let's say, Apple, Microsoft, all the big names or companies you're familiar with, which are part of the S&P 500, including all the consumer companies, oil companies, etc. The fund owns the individual stocks, SPY. However, if you go to XDTE on the other side, they own deep in the money calls, or they own the call option. They don't own the individual stock, they own the option. They own long dated options, which works similar to the stock. They mathematically replicate the performance of the stock. So that's the synthetic index replication. Now, what is synthetic replication? Yeah, it's basically using call option instead of buying the stock. So when the price of the stock goes up, the call option also goes up. So that's what they're trying to do in case of XDTE. Whereas in SPY, it's a simple, they own the real stocks which are part of the 500 companies in the S&P 500 index. Now, what is the investing strategy that generates the returns or the income for the fund? The SPY uses the dynamic covered call strategy to generate income. Okay, and they also use something called the call spreads. So call spread is something like if the market moves up pretty fast, they can write higher level call options to capture the extra upside beyond the strike price. I said in one of some of my previous videos that when you write call options, you're actually capping your upside or limiting your upside. Whereas if you do a little bit of call spreads, you can actually uh, move the limit a little bit higher and capture extra upside. That's exactly what SPY is doing. So SPY generates the regular call option income, plus they'll generate extra income from the covered call spreads. And Yeah, so that way they're able to capture the extra upside, which the traditional covered call funds cannot do. Now, what about XDTE? XDTE actually uses the call options to replicate the index, which means that instead of buying the stock, they buy the call option, which is cheaper and uses less capital. And using that as the underlying asset, they write everyday call options, the daily call options. So when you write daily call options, you're able to generate daily income. The fund manager writes daily call option and they generate option income on a daily basis on every trading day. In the morning, they may write the option. Later on, they may close the option or the option expires by end of day. So income is generated on a daily basis. However, one point to keep in mind is that when you do daily option, it does not guarantee or it does not mean that you will make a profit. Like you sometimes you make a little bit of loss, or sometimes you close that transaction to minimize the loss. So technically, yeah, you may get P&L, profit and loss, but net the fund aims to generate some profit or income, and that's how they are able to pay weekly distributions. Since they are generating income every day, by Friday or at some day on the week, they're able to distribute income to you. So that's the secret sauce, or that's the investing formula that XDTE follows. And SPYI follows the regular monthly income options. And that's why they distribute every month. So you will see there is an impact of the higher frequency of distribution in case of XDTE, because they're every week they have to distribute. So sometimes they could be giving more in terms of distribution compared to what they are earning. So it's basically based on the estimate that they are paying you. So yeah, so that's has its own pros and cons. How much money the fund is distributing back to you, and it has some tax consequences. Um, so I mean, by now I'm sure you understand the difference between these SPYI and XTT. Okay, now this is the most complex part, like kind of a black box that some funds don't reveal at all, and some funds yes make it open, and these funds have given some indication or some information, uh, but they won't tell you the entire thing because things keep changing in the market, and depending on the conditions of the market or conditions of their positions, etc., they may change strategies. And that flexibility is important to affect your returns and to generate regular income. SPYI, they do a dynamic cover call writing, and it is at the manager's discretion, like how much of coverage they use, how much of out of money in the money, sorry, out of money or at the money they write. All that is very discretionary. And similarly is the case with XDTE. But in case of XDTE, they write zero DTE calls, usually out of money. So that's how it works. But it's not set in stone. They may do at the money calls as well. When you look at the covered upside, like when I talk about covered upside, what about the covered portion of the portfolio? The covered portion of the portfolio can also generate appreciation for SPYI because they use call spreads. We already discussed that before. Because they use the extra call writing spreads, so they can generate extra income above the option strikes. Spread is basically something like they sell a call and they buy a call and pocket the difference. Okay, so that's a big topic by itself. It goes beyond the video, like, but that's how the fund managers do it, and it is difficult for us, like individuals, to do that kind of strategy because it's very complex and you have to monitor on a regular basis. Okay, XDT they do more like a daily writing of the calls, and the good news is they every day once the calls are written, the next day they can do a fresh amount of call writing. So which means that whether they make a profit or loss, it gets reset every day. So imagine like in a month, you have like 20, imagine there are 20 trading days in a month. So they have 20 opportunities to make profit. So at every opportunity, they may not make a profit. Let's say 70% of the time they make gain. So that way they are able to use the probabilities in their favor. You know, even if I lose Um, I win on 7 days, I lose on 3 days. So in a month, I win on 14 days and I lose on 6 days. I'm still making a good profit because I have good amount of wins against some amount of little losses. So overall, I'm making a big profit. So that's how it works. And the mechanics are difficult to explain, but that's a simple way to explain it. The way I said, you are using the probabilities to your favor because you're writing calls on everyday basis. Whereas in case of SPYI, like it's every month. So once I write the call for June month, for example, this month, I'm done for this month. Then I have to wait for the next month to do the next strategy, next kind of position writing. So, so that way the funds are a little differently. So in this case, XDTE has a slightly better edge compared to SPYI. But SPYI actually does more than traditional covered call writing. They do spreads as well. So that way they're able to get a little bit of edge compared to the traditional covered calls. So SPYI is also kind of trying to use a different kind of strategy or different kind of tactic to get ahead in the game. No, nobody wants to stay behind, right? They want to get ahead in some way or the other. Okay, now looking at the uncovered upside. Uncovered meaning like the part which is not covered by the covered calls, meaning the stocks or portfolio which is not written, like basically the underlying stocks which are not under the covered call writing program. Now, in the case of SPYI, let's say some part of the portfolio is written off. Let's say 50% of the portfolio goes off in the covered calls. The remaining 50% will have full upside, or you know, the underlying stocks can have capital appreciation. The underlying stocks can also generate dividend income. This dividend I'm talking about is the dividend from the underlying stocks. So that exists in SPYI, whereas in this one, in XDT, they have just the call option. So they don't get benefit directly, but they get some capital appreciation benefit, but they don't get the benefit of dividends. So I've covered the additional features point. The SPYI benefits from the underlying stock dividends flowing into the fund, whereas XGTE does not have that aspect because they don't hold the underlying stocks. So that's kind of you know pro for SPYI. It's a con for XGTE. So I think this gives you an idea of how the option dynamics work. Uh, some of you may not be too familiar with some terms or some aspects, but if you're someone who is not familiar with options at all, or you want to have a bit of index and real stocks in your portfolio, it's good to go with SPYI rather than XDT. XDT is very attractive, and many people jump into it because of the weekly distributions. But the moment they see the price eroding, uh, they get a panic situation because they don't know how the fund works. And if you're not sure how the fund works, no matter how good it is, like you should not be putting a major portion of your money into that. So with that, let's go to the next part as we're going to wrap up this video. Okay. So now we have seen all the different features and aspects. Now with the XDT, yes, I'm not making a big killing on that fund. I'm not also losing or panicking out of it. I'm using it as a kind of a cash flow strategy to bring in regular cash flow into my portfolio, which I can reinvest into other funds, other ETFs, or I can, you know, invest a small portion back into the XDT so I can increase that cash flow. So that's my strategy, which I promise that I will tell you at the end. Uh, is it working really well? Yes, absolutely working well. Yes, there is a price erosion, and dividend yield or the distribution yield is pretty good. Um, okay, so now who is it suitable for? That's what you are here for. Like, what's in it for you? Um, the first one, who is it suitable for? Like each fund, we'll just take a quick look at it. I'll first explain the SPYI, then I'll explain the XTTE. So I'm going to go, on the SPYI first. I'll explain all the points. The first one is you want an index exposure. You want the S&P 500 exposure, and you are looking for a moderate capital appreciation or capital stability. Meaning, the fund, let's say the fund NAV is about $50. You want the fund NAV to stay at $50 or move up to $52 or slightly higher in 1 year, and keep moving a little bit higher or stay consistent or strong. Then SPYI is for you. And the SPYI also writes monthly covered calls, and the monthly distribution is kind of stable. Now, I'll quickly show you one part of it which you may want to see before I go further. I will show you the returns of both the funds. We were talking about returns, right? So I will show you the returns here quickly. Uh, SPYI and XDTE, I just compared it. So the comparison starts from March 2024. Okay, and just to quickly get you, you know, understand this, like both are starting with $10,000 of investment, and ending investment is 13,997 for SPYI and 14,188 for STTE. So this is the first part of the screen that you see on the top. It shows you the um, growth of $10,000 with dividends. So I'm just expanding the screen so you can see it. So with dividends, you can see that the difference is not much. SPYI made about 40% and HDDE close to 42%. Yeah, it's a significant difference, but not not trying to say that SPYI is bad or HDDE is good. Like it seems to be almost pretty close, like not that far in terms of the performance. But come to the other side without dividends being reinvested. If you're not reinvesting the dividends, you just want to invest a certain amount of funds for a certain amount of time and then set it and forget it. You don't want to go back and reinvest and all that. So in that case, what happens is SPY-I is generating a higher return of 14.21%. XDTE is about 12.66. Again, around 1.6% difference. Uh, Again, not to say that XDTE is bad. Yes, if you're not reinvesting, yes, it's going to give you little less returns, but still it's doing its job, and you are getting the double-digit returns. I'm talking about the total return, average annual total return here. So this is what you're making on an annual basis. And here you can see like you are making an average annual returns of 17% in XDTE. So average annual basis, not much of a difference. Yeah, if you look at the compounded return, total return, yeah, you can see the difference here. So, long story short, like whichever fund you choose, you are going to gain in one way or the other. But if you're someone who doesn't want to see your fund value go down, you may want to go with a SPY-I. If you don't mind seeing the fund value go down and you're not worried about that, and you're seeking higher level of income, XTTE would be a great option. And if you are little risk averse and you want your fund to maintain its value, or you want to have the exposure to real stocks, not the options or the synthetic strategy, go with SPY-I. Again, not investment advice. Do your own research and consult a financial advisor. Yeah, so with that, let's go back to the video. And yeah, so there's a higher potential for higher returns beyond the upside cap for SPY-I, whereas in the XGD, you don't have that option. And of course, there are some favorable tax uh, treatment for SPY-I, Section 1256 contracts. I'm not an expert on the tax, so I'm not going into this. You can consult with your financial advisor or accountant. Uh, Now, coming to the HTTE part of it, like you get the index exposure synthetically, like not using the stocks, but using the call option. And you have moderate capital appreciation because when there is an appreciation, the fund value moves up and they're able to extract that value in terms of daily option writing. So every day it is reset. And you have the weekly distribution, but the distributions in case of XDTE are too much up and down, like varies a lot because of the high volatility and changes in the market. And you also have things like overnight positions. Sometimes overnight, if the markets go down or go up, XDTE will get quickly influenced by that. But whereas in SPY-I, since they are writing monthly options, yes, there is going to be an impact, but once it is set, you're not going to see much of a variability. And daily reset in case of XTTE helps to capture more returns on a small returns on everyday basis. So yeah, so that's how you can assess the suitability. If you're looking for cash flow or income, XDT is a great option. However, make it a very small portion of your portfolio and then gradually scale it up. Don't depend on that for your income or your regular income needs. Probably it may not work for you because the income variability is too high, it's not guaranteed. Okay, what are the risks? SPYI is market linked, so you market goes up or market goes down, you're going to take that risk. And underlying stocks, they protect you. Like even if the option strategy goes wrong or they don't do any option writing or the premiums are less, you still have exposure to the S&P 500 stocks, capital appreciation, and the stock dividends as well. So underlying exposure is pretty good. Whereas if you look at the XDTE, there is a depletion of NAV or index declines. Yes, that can happen. I mean, that is in both funds, this can happen. And they don't have any underlying exposure, whereas SPYI has underlying exposure. Now, let me come to the third point. In case of SPYI, the NAV declines, but it also recovers pretty decently. I would say sometimes fast, sometimes a little moderate pace, but the NAV recovers. Like if you look at the price of the stock on Google or something, you will get the idea. But whereas in case of XTT, there is a tendency to lag in the recovery. It takes a lot of, it grinds, once it falls off, like it has to grind a lot to come up to its previous levels. So that can be a risk that you need to be aware of. The reason I'm putting that is because a lot of people look at the high yield, like 40%, 50%, and then jump into the fund. But later on, they find that, the fund goes down in value and then takes a lot of time to recover. So, long story short, um, I don't think I missed too much on SPYI because my whole idea of investing in XDTE was to generate that cash flow, that income for other investment opportunities. The second reason was, I am aware that this is going to deplete, and I have a plan to keep XTTE for a long term. But if the performance is not good enough, if it is not able to recover at least 80-90% of its value, then I need to think about how to deal with that. But since I'm getting solid positive total returns, I don't think there's any reason for me to panic. This is my situation. And other people who are holding XTT, you can share your comments or your feedback below. And thanks a lot for watching this channel. I see that a lot of people are not subscribed to this channel. So if you have not done this, and if you want to support us, please subscribe to this channel. And if you like this video, please give us a hype. Thank you for watching. Thanks for your time and have a great day. Happy investing.